Welcome back to the Deep Dive. Today we are taking a close look at a company whose recent struggles, they really tell the story of the wider economy, specifically the forces shaping one of the most essential and cyclical sectors we have, the housing market.
Yeah.
We are talking about RH, the luxury home goods retailer, formerly known as Restoration Hardware.
That's right. If you want a perfect case study in how macroeconomics, immediately trickles down to consumer behavior and corporate balance sheets, RH is it.
Right.
When the Federal Reserve raises rates and the housing market just freezes up, luxury home furnishing purchases, the exact thing RH sells, are often the first to be postponed.
So the core problem is crystal clear. The weak housing market has taken a severe financial toll on them.
Okay.
We're talking a sharp downturn in revenue.
Or a brutal one.
But here's the interesting part, and why this deep dive is so timely. The sources we looked at suggest that this challenging period, this downturn, is exactly what sets up a unique investment opportunity.
But there's a big if there.
A very big if. It's only an opportunity if you believe, as these analysts do, that a substantial housing recovery is on the near horizon. It's really a bet on the future of American homeownership.
Exactly. It's not just a study in volatility. It's a playbook on how to weather a sector-specific storm. The sources believe RH has taken its lumps, but the brand itself, it remains intact.
Okay, let's unpack this. We need some context here.
Yep.
We are looking at a stock that has been absolutely hammered.
Oh, yeah.
If we zoom out and look at the last 5 years, RH stock has lost more than half its value.
Which is staggering when you think about the market overall.
Exactly. The S&P 500 has risen a colossal 87% in that same period.
That massive underperformance is really the price of admission for this deep dive. The company got caught just flat-footed by the speed of the interest rate hikes.
It essentially slammed the brakes on their entire consumer base.
Completely.
So how did they get here? How does a brand that sells, $10,000 couches drop so fast while the rest of the market flourished?
The short answer is what we call cyclical exposure. RH's business is just inextricably linked to the housing transaction cycle.
So people moving, people renovating.
Exactly. Their customers typically buy when they are moving into a new home, completing a massive high-end renovation or, furnishing an addition. These are not impulse purchases.
Well,
This is a luxury good. It's driven by discretionary income and, crucially, access to cheap credit. So when interest rates rise, mortgage rates climb.
and the housing market slows to a crawl.
And RH slows immediately after.
And the numbers that illustrate this impact are really dramatic. They show just how extreme that volatility can be. We are talking about a massive revenue swing.
To give you the specific data points, RH revenue peaked at a phenomenal $1 billion in the third quarter of 2021.
$1 billion. That was the height of the housing frenzy, right? Pandemic spending on homes.
That's it. And then the fall was steep. It shows the immediate effect of the Fed stepping in. That revenue fell all the way down to a low of $727 million by fiscal Q1 2024.
Wow. So there's a 27% drop from peak to trough.
It's significant. It's like losing more than 1 out of every 4 customers almost overnight. I mean, a revenue swing like that would cripple many companies.
It just shows how exposed they were.
Completely exposed to the housing euphoria and then the correction that followed.
But what's fascinating here and what makes the sources so optimistic is that this massive downswing may already be leveling off. They note that RH has started to see a modest recovery.
The most recent quarter's revenue actually increased to about $899 million.
Okay, so that does signal a possible turning point. It suggests the worst of the housing slump might already be in the rearview mirror.
That 899 figure is a crucial data point for anyone tracking this story. It suggests the financial freefall has stopped and the company is finding a new base of demand.
Oh, logically, if revenue's ticking up, the stock should be reacting positively. But it hasn't.
It hasn't, and that's the puzzle.
Yeah, that's where it gets really interesting. Despite that modest revenue recovery, that 899 number we just discussed, the stock is still down 58% year to date.
Yeah.
Why? If the core business is finding its feet, why is the market still so bearish?
Well, the analysts agree that this continued drag isn't about revenue anymore. It's about margins and uncertainty.
Oh,
The sources identify 2 main reasons for this continued fear. Uncertainty around global tariffs and increased competition. These factors just reduce investor visibility into future profits.
Ah, the dreaded margin squeeze.
Exactly.
For a luxury retailer like RH, operating margin is everything. They have to command those high prices to maintain that luxury image. Margins are the proof.
Precisely. And before the downturn, when the housing market was flying high, RH recorded an operating profit margin of more than 20%.
Which is a phenomenal number, elite tier for retail.
Absolutely. However, on a trailing 12-month basis through the recent quarter, that operating margin has been squeezed all the way down to just 12%.
Wait, okay, I want to pause on that 12% figure. Can you break that down for a listener who might not be tracking these finance concepts every day? We're talking operating margin, not just gross margin.
That's a great point. So think of gross margin, which is still a solid 44.65% for RH, as the money they keep after just, making the sofa.
The cost of the goods themselves.
Right. But operating margin is the money they keep after paying for everything else. All the shipping, all the overhead, running those stunning showrooms, paying designers, and crucially, paying for tariffs.
So that difference, that 8 percentage point drop from 20 to 12%, is where all the pain is.
That is where all the financial pain and investor fear is concentrated. It shows that the costs of doing business have eaten deeply into their ultimate profitability.
8 points of margin is enormous. Does the market think this is a permanent shift? Are they worried that luxurious pricing power is starting to erode?
That's the core tension.
Oh.
But the analysts we're looking at, they push back hard on that idea of permanent damage. They insist that the fundamental strength of the RH brand, its prestige, its quality, that it all remains undamaged. They're arguing the margin hit is almost entirely due to temporary external costs.
Like the tariffs.
Exactly. The tariffs and the sheer cost of keeping a major retail operation running during a revenue slump. That compression is why the modest revenue recovery hasn't translated into a stock rebound. Not yet.
The margin recovery story is the critical piece.
It's everything.
Okay, so we've established the pain in the puzzle. Now let's get to the central investment thesis from the sources. The idea that RH is attractive right now because of powerful external factors that are about to swing in their favor.
This is the macro so what? And the single largest catalyst here is the Federal Reserve. The overwhelming consensus is that the Fed will continue lowering interest rates over the next year.
And we know exactly how that translates to RH.
We do. Lower rates mean lower mortgage rates. Lower mortgage rates make homes more affordable. They encourage refinancing. They unlock equity for renovations.
It's the tide that lifts RH's entire boat.
That's the perfect way to put it. The analysts are essentially framing this stock as a high-leverage bet on the housing market finding its feet again.
But betting on the Fed feels, I don't know, inherently risky?
Mm-hmm.
What happens if the recovery is slower than expected? Or if the Fed hits a speed bump?
The downside risk is primarily a prolonged waiting period. The analysts really emphasize that the brand itself is fundamentally sound. They believe that even if the recovery takes longer, quote, nothing has damaged its brand or ability to profitably grow over the long term.
But you have to be patient.
You nailed the key caveat. If you're investing in this thesis, you have to be prepared for a long hold. This is positioned as a serious buying opportunity only for long-term investors.
How long are we talking?
The analysis insists on a minimum 5-year hold period to realize the full potential of this rebound. You are buying the stock at a 12% operating margin in anticipation of a 20% operating margin.
That makes sense. It's a deep discount tied to a long time horizon. Okay, so let's pivot from those big macro tailwinds to the internal fixes. What are their growth pillars that move them beyond relying just on the U.S. housing market?
The first major internal pillar is global expansion. Specifically, their aggressive move into Europe. This is a deliberate, proactive strategy to diversify their revenue.
And the early results seem pretty promising, right? We're talking specifics here. Demand in England has been robust, up 76% in the recent quarter alone.
A huge spike. It suggests that the luxury appeal translates internationally, which is crucial validation for the brand. But, and this is important, you have to understand the trade-off.
High upfront costs.
Very high upfront costs. They're establishing these massive multi-story showrooms, setting up new logistics networks, importing specialized inventory. It's a huge undertaking.
This sounds like a tremendous cash burn in the short term, especially when they're trying to manage margin compression back home.
They're viewing it as a long-term capital investment. Analysts project that while these costs will definitely hit short-term earnings, this land and expand model will eventually lead to significantly higher profits.
tapping into entirely new, wealthy customer bases.
Exactly. The success in England is the proof of concept. Now they just need that model to scale across the rest of the continent.
Okay, that brings us to the second pillar, managing those tricky external costs we mentioned earlier, the tariffs.
Correct. For a long time, the tariffs on goods imported from certain regions have been a painful drag. RH's strategy here isn't just to absorb it.
They're being proactive.
Very. They're actively managing two things at once: adjusting selling prices to offset the higher costs, and more importantly, strategically shifting their supply chain.
Adjusting prices on high-end luxury goods is a tightrope walk, though. You can't just hike the price of a dining table by 15% without alienating your clientele, even if they are wealthy.
It's done gradually and strategically. They're weaving these increases in while updating products or launching new collections. It seems less like a cost pass-through and more like, the price of novelty.
And at the same time, they're moving manufacturing.
Exactly. Moving it out of affected regions and into countries where tariffs are lower or non-existent. That process takes a year or two, but eventually it removes the cost pressure entirely.
Okay, so let's tie all this together. If the Fed lowers rates, housing recovers, they succeed in Europe, and they manage these tariffs, what does the long-term balance sheet look like?
The analysts' expectations confirm a very ambitious target trajectory back toward peak profitability. They expect RH's operating margin to climb all the way back up to nearly 20% by fiscal 2030.
Back to 20%, a full cyclical recovery on the profitability front.
That's the target.
What does that kind of margin recovery do to the bottom line for shareholders?
Well, it could translate to a massive 46% compound annual growth in adjusted earnings per share.
46%, that's an incredible growth trajectory.
It is. Moving from 12% operating margins today back towards those peak 20% margins, all while leveraging higher revenue on a leaner cost structure.
And right now, the valuation metrics seem to support this view that the stock is trading at a steep discount to that potential. We see a forward PE ratio of 12.8. Can you put that into context? What does a PE of 12.8 actually tell us?
Sure. The price-to-earnings ratio, or PE, is just a measure of what investors are willing to pay for every dollar of the company's expected future earnings. A PE of 12.8 means the stock price is just under 13 times its forward earnings.
Which sounds cheap.
Given the broader market averages, and especially when measured against that projected 46% EPS growth rate, analysts view this PE as extremely cheap. Investors are basically discounting the stock heavily because they're worried that 20% margin recovery won't happen.
So the combination of that deep current discount, the anticipated margin recovery, and that explosive growth rate suggests the potential for truly incredible returns over the next 5 years.
Assuming the thesis holds, yes. And it's always helpful to ground this analysis in the source's credibility. It's worth noting that the analyst team providing this data has a particularly robust track record.
They do. The sources cite that this analyst team achieved a total average return of 991%.
991% compared to 195% for the S&P 500 over a comparable period.
Wow, a 991% return track record definitely earns the benefit of the doubt on this thesis. They've proven they can spot these kinds of undervalued cyclical plays.
They have. They've spotted these recovery scenarios before and have the data to back up their confidence in RH's long-term brand equity.
So let's wrap this deep dive up.
Yeah.
We've tracked RH from a severe cyclical downturn where it lost more than half its value to a very clear analyst-backed path for a potential recovery.
And that recovery is driven equally by those massive external macroeconomics like the Fed rate cuts and their internal strategic moves into places like Europe.
Right, and the aggressive tariff management.
It really reaffirms the core idea for you, the listener. This is a textbook scenario. You have an undamaged luxury brand that is perfectly positioned to benefit dramatically from a sector-wide rebound.
But the catch is the timeline.
The risk-reward is tied directly to that time frame. A minimum 5-year commitment is suggested to realize the full value of those margin and earnings recovery projections.
So what does this all mean for you as a learner? Here's a final provocative thought to consider. If RH's European expansion proves that its high-cost, high-reward global scaling model works, what other luxury retailers, currently trapped by domestic cyclical pressures or high tariffs, might follow a similar blueprint to unlock massive, long-term international value?
That's a great question. If the brand is strong enough, That high upfront cost is just the price of admission to a much larger, less cyclically dependent market.
So you should be looking at other premium home goods or luxury names.
Yeah, and assessing if their core brand strength really matches what RH is successfully demonstrating over in England right now.
Absolutely. We hope this deep dive gave you a clear and concise understanding of the RH cycle, moving you from raw data to actionable insight. We will catch you on the next one.